The potential for increased bankruptcies, given the threat of a global recession as a result of the COVID-19 pandemic, along with disruptions in the complex global supply chains, are expected to have a significant negative impact on trade credit insurers. Joining us now to speak more about that is Sridhar Manyem, AM Best Director, and Mathilde Jakobsen, Director of Analytics, AM Best. And Mathilde, let's start with you. From a claims perspective, what do we expect to see here?
With a global recession threatening the world economy, we expect to see an increase in insolvencies and thereby also an increase in trade credit insurance losses. Depending on the level of increase in insolvency and also on the success of the mitigating actions that insurers are now taking, we could see claims ratios rise up towards the level they last reached in the global financial crisis of 2008-9.
Can trade credit insurers do anything in the short term to mitigate the pain of these disruptions?
The short-term nature of the product will help mitigate the losses, as it allows trade credit insurers to very quickly reprice and de-risk their portfolios. Ultimately, trade credit insurers can manage their risk exposure very quickly by reducing or withdrawing capacity from the areas that they think are most at risk. We also expect the actions taken by central banks and governments across the world to help dampen the impact on trade credit insurers. Still, the potential impact on loss ratios remains subject to a lot of uncertainty, and we certainly monitor the performance of our rated trade credit insurers very closely.
Mathilde, what are the reinsurance ramifications?
Trade credit insurance tend to use a lot of reinsurance to support their underwriting capacity, and this will serve to limit the amount of net losses they'll see from the crisis. But it also makes them reliant on reinsurance and thereby subject to changes in terms and conditions and withdrawal of reinsurance capacity that can follow a crisis. For the rated trade credit insurers we expect that to be mitigated by the long-standing relationships they have with their reinsurers, which are typically of high credit quality.
Sridhar, what are the medium-term implications of the pandemic on the trade credit segment?
As Mathilde pointed out, there are going to be severe short-term implications, but even over the medium term, there are going to be a lot of implications for trade credit insurers from the COVID-19 pandemic. Even entering 2020, the insurers were reasonably cautious because the global leverage was increasing, exacerbated by trade wars and global protectionism. So they were looking at possibilities for increasing bankruptcies and insolvencies. And this particular event, the COVID pandemic, has severely exacerbated the stress on these insurers. And we could see, as we said in our report, loss ratios climbing up significantly, pretty close to the 2008-2009 financial crisis, as Mathilde has already said. And in terms of the implications, the trade credit insurers are going to take a look at everything from pricing, claims management, reinsurance. They're going to look at more transparency into their reinsurance, into their reinsurers. And of course, there's going to be vice versa, the reinsurers wanting to look at the insurers' books more closely as well. So there's across the value chain of the trade credit insurance operations, there's going to be close re-examination. And we also expect to see claims being played out in various jurisdictions, and there's going to be legal aspects to this, and we expect this event to have a much longer tail, as it takes a while in the courts to play out, and it is going to be a very good time to graduate from law school as well.
So what is the key takeaway from an ERM perspective for insurers?
From an ERM perspective, there's going to be plenty of lessons learned. overall, the ERM frameworks of insurance companies has stood well so far through the SARS pandemic, natural catastrophes, man-made catastrophes, and apart from the brief blip during the 2008 great financial crisis, the results of trade credit insurers have been reasonably stable. So with this particular pandemic, it is different from other catastrophes because it has been global in nature. It has not been confined to a specific country or a region. So there has been a global impact, and there has also been an impact across multiple lines of businesses. So insurance companies will be looking at aggregate risk tolerances, stress testing across multiple lines as opposed to concentrating on siloed stress testing, etc. And plus, even the global supply chain has been more focused on efficiency as opposed to resilience. So there's been a lot of focus on just-in-time inventories, just-in-time supply chains, so on and so forth. So there hasn't been much resilience built into the system. So any single failure has triggered a huge impact. So maybe there's going to be more focus on resilience as well in the future. So to build some backup plans in terms of even operations wise for an event like this. And insurers can probably take the lessons learned from the global nature of this event and apply to other events. Maybe a cyber scenario could cut across multiple lines, multiple geographies, so on and so forth. So there is going to be lessons learned from this, and insurers are going to relook at their tolerances and strategy.
Thanks, Sridhar. Mathilde. You can find the full report, Trade Credit Insurance COVID-19 May Have Long-Term Implications, online at ambest.com. For AM Best TV, I'm John Weber.